In today's video, we're going to discuss how your health rating can essentially affect the performance of a policy / the break-even point. And so in the previous video, what I did is I shared with you a perfectly to the T, max funded, performing high performance policy to the T for all areas that it could possibly be. And through that, it gave us the ability to have high early cash value really early on, high liquidity. And if you want to take a look at that video, it gives you a 30-foot overview of what we're going to dive into each specific category. And in this section, we are going to dive into how your health rating can essentially affect the policy performance and design. So when we're taking a peek at it, what we're going to do is we're going to use the same exact illustration that we used in that 30-foot overview of sharing high early cash value. That policy broke even at year 4. And we're going to share the screen again so you have the ability to see that exact one that we used in the last video. And then I'm going to pull up the new illustration that's going to show, based off of health performance, how it has changed. And we're just going to compare them apples to apples. How did the health performance at the end of the day change the policy? So let's go ahead and share my screen with you so you can see it. So here's the design that we looked at in the previous video. Just real recap, 92% liquidity. You had break even year 4, 250, 782. 250 you put into the policy. Okay. Super preferred non-tobacco was the health. All I did was change this section right here, left everything exactly the same, female age 35, just change it from super preferred no tobacco to standard. So let's go ahead and pull up the standard health rating. And here's the difference. So now we have year 1, 91.7% liquidity. So it went to 91,000. So it dropped it down a little bit. And you'll also see the break even point now is year 5. So 300,000 in, 305. Year 4, you put in 250 and you still have less cash value than you put into the policy. So you can see that it's not a drastic difference, right? There's about $2,000 difference in the break even points and when that kind of turnover happens there. And you have about $1,000 or so difference in year 1 in regards to the amount of, liquidity from a cash value perspective. From a death benefit perspective here, you'll see there's 1.741. And if we look at the other one, you'll see that there's 1.743. So there's a little bit more cash value. There's a little bit more death benefit in the super preferred health rating. Now, let's take a look at maybe the longer term performance of how this works. And we can see that as well. So the super preferred, if we're going to look at year 10, so we'll go all the way over year 10 cash value, 645, 131. Now let's go ahead and take a look at the standard one. Year 10, 636, 779. So when we're looking back and forth at the two, there's really only about a $9,000 difference within 10 years. $9,000 isn't nothing to blink over, but at the end of the day, because of what we're doing, how we're designing the policies, the intention of them, how they perform, it still is a very high performing policy when we're able to design it the way we design it, even if the health rating is not favorable. And now the health rating can be not favorable for many reasons. It could be due to height, weight. It could be due to underlying health conditions that you may not even been aware of, past medical history, family history. There's lots of things that can be put into why you may not have got the best health rating. I've been underwritten. So underwritten means just going through the health process with 2 different companies. The first company gave me a standard rating and I was in the same exact health. I was probably actually, maybe even a little bit more healthier. I mean, it's hard to say the differences, but as a whole, I was definitely lighter. I wasn't as big, same height, same everything. And I got a standard rating. That could be a bunch of different factors. It could have, I've heard from the grapevine, it was because I was potentially taking protein. I had these certain protein molecules of being an athlete that were coming up in the blood test. The second company I got underwritten with, I didn't even take a blood test. So that might've been the reason why I got the best health rating the second time around. To be honest with you, sometimes I don't even know why companies rate certain people the health ratings that they do. Sometimes they come back and then share it. They'll say, hey, it's because of future history of, past history of your family or early history of cancer in your family. It could be height, weight, it could be a bunch of different factors. And sometimes the insurance companies do share that. But for myself, I still have to this day, I have no idea why that is. So for one policy, having a standard rating, it's still fine because it was designed right, high performance cash value, still can borrow against it, still everything up to the T, to the par of what I wanted to do. And then the other factor, having a new policy that's giving me the best health rating, I'm going to have slightly more efficiency. And I'm super, super thankful for that. So at the end of the day, as long as there's not some of underlying health condition that essentially is going to lead you to, a near death experience here relatively soon, there's lots of ways that you can still get a overfunded whole life insurance policy and not have the best health rating and it still perform extremely well. So if health is a concern, I don't want that to get in the way of leasing if it could benefit you. Because at the end of the day, just going through the health process can give us a lot of data of what they can give you from a health rating perspective. And then from there, the process will essentially be, once we get the health rating, we can come back and say, okay, does it or does it not make sense based off of what you're trying to accomplish, based off of the numbers. So hope this helps. The next thing we're going to do is we're just going to go over the list of how policy performance changed based off of certain characteristics that we changed just slightly, right? We looked at the health performance today. We're going to look at gender. We're going to look at design. We're going to look at age. We're going to look at term riders. We're going to look at all these different factors that change the performance. That's going to change the liquidity earlier on and the break-even points. So hope you got a ton of value from here, and we're looking forward to the next video.
Hey, I want to thank you so much for watching this video to the end. This video is on life insurance, and if you have more questions about life insurance, infinite banking, why you should overfund it, we have a link below that goes to our And Asset Vault. This is a free vault that gives you everything you need to know about life insurance. We have case studies, we have a calculator on there, we have a handbook, we have frequently asked questions, we go through a process. I have my masterclass on there. We literally want to be the one-stop shop for every life insurance decision. And so if you want to learn more, click the link below, and we look forward to educating and maybe opening your mind and eyes to the power of life insurance.